Victoria, great to have you back on. And by the way, great calls, because last year, I get it, and there's still a lot of people that'll say they'll never invest in oil and gas stocks again. You're there in Texas, and you said there are names that we can confidently invest in and feel good about it. So congrats. What sort of did you see that maybe others missed?
I think the ESG trend is obviously the long-term trend, but it takes a long time to adopt. And so we looked at where prices, where production was, the number of rig counts, and you realize there was probably going to be a shortage. So we liked that, as we also liked it as historically a great inflation offset. So we were happy to be a little bit early. I think it's a trend we're going to continue to ride. But I think people need to understand, while ESG is the future and EVs and solar, there's still a lot of technology and infrastructure to figure out. So we looked around and said, somebody's got to be running all these cars, and also, as you pointed out, the power backup. Somebody's providing jet fuel. So we're glad that they've had this run. I think it's a great place in the market to be, and it also doesn't have the issues that the tech variables have right now with where multiples are so high.
Yeah, and they might bet multiples, by the way, were not now, but they were when you started talking about these stocks at multi-year or decade lows. By the way, yeah. Are you trimming any at all, though, Victoria? They've had, remarkable runs, some of them in just a couple of weeks.
I know. And if you look at it, you had a lot of the EMPs, as we talked about. I'm bullish on Devon, Fang, EOG, and also Conoco. They're all in the EMP space in the Permian. Right now, we're just kind of letting them run. We are looking to pull back a little bit if oil hits above 100. Oil above 100 really isn't as sustainable. We'd like it to stay in the 70 to 80 sweet spot. At above 100, first off, you start bringing more supply online, attracting more rigs to come on past. OPEC may stop playing quite as nice, as well as then it also is a drag on the consumer's wallet. We don't want that. We want this economy to still be strong. We don't want to be having people having to sacrifice consumer spending because they're having to fill up their tank. And over 100 has historically been difficult to sustain.
The ETFs, of course, they've been recommended a lot. By the way, viewers, tune in. I'll be hosting Fast Money at 5 p.m. tonight. I call it 10 the hard way. And we talk a lot about ETFs sometimes, OIH, XOP, XLE. Those are made up of a bunch of companies. Sounds like, Victoria, you're saying that you need to go with best of breed. A Diamondback, Travis Stice. We interviewed the CEO in November in Houston, very optimistic. Bill Thomas, EOG, always in the list of top management. Is that kind of you got to be a stock picker, not a macro buyer?
I think you do want to be in the right place. And the names I like is because they're shareholder friendly and they're not going back to the wildcatting days. And I think that's one of the differences in this crude rally. You're not seeing all of this demand suddenly come on. They're very, very disciplined with their capital, and they're very shareholder friendly, and they're going to be free cash flow generators. They're going to be cash cows. And a lot of them have this fixed plus variable dividend now, where over 50% of free cash flow is now being distributed as a variable dividend as well as their base dividends. And so you're going to be in a market that, one, is a great inflation offset. 2, typically does well during a period of rising rates in a growing economy. 3, the industry has shifted much more shareholder friendly. Yeah. Instead of CapEx, now you're seeing the money return to shareholders. So yes, buy the names that you like. Be picky. It's going to matter what you own this year.